My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to America. I'll be with my friends, just trying to make a little money over here. My job, not just to entertain, but to educate, to teach you. Call me 1-800-743-CNBC. Tweet me at Jim Cramer. If the federal government is giving money away, I think you should take it. Today, Uncle Sam decided to give a lot of money away, yet very few people took advantage of the opportunity. Well, you couldn't tell from the averages. Dow gaining 127 points, S&P advancing 0.48%, NASDAQ climbing 0.75% to a new all-time record. But today, the market was consumed by smaller investors buying shares in lousy meme stocks like GameStop and AMC. They're betting that, like in January 2021, the short sellers won't be able to take the pain.
The house of pain.
And when that happens, the shorts need to go buy in stock. Buy. Creating what's known as a short squeeze to propel stocks to ever-dizzying heights, even much higher than we saw today. Now, we don't know when that ends, but it does end eventually, and it doesn't end well. It sure ended the last time we did this in 2021, leaving many people holding a deflated bag. Hey, more on that later. For now, though, I want to talk about the big opportunity nobody seemed to care about. Washington's giving money away. Where? In a fact sheet that hit my desk from the White House titled, quote, President Biden takes action to protect American workers and businesses from China's unfair trading practices. Wow, here it comes. The gist. The president believes that the Chinese are, I'm going to quote again, flooding global markets with artificially low-price exports, end quote. So Biden's using his power to slap tariffs on an $18 billion in exports from China. That's meaningful. Normally, once that kind of news gets published, any stock that could conceivably benefit would soar. But you see, today investors were so drawn to illusory short-busting opportunities that they overlook these very real tariff opportunities. There are now a host of industries that are about to be protected by bigger tariffs on Chinese exports, and it will help their sales and earnings for years. Now, some of them, like steel, don't really matter because our government's already done a real good job shutting down the Chinese steel. But there are others where these tariffs boosts are a very big deal. Let's start with the biggest single winner that nobody cared about, Owens and Minor. Now, the government's slapping 25% tariffs on Chinese face masks and surgical gloves. Previously, the tariff was 0 to 7.5% for this PPE. Owens and Minor is the dominant American player in the space, so it can probably take some share here. Now, the stock is well off its highs after a poorly received quarter, and it seems very viable, and no one cared. Next beneficiary, makers of syringes and needles. China is being hit with a 50% tariff on these medical supplies, up from 0. Like masks and gloves, Chinese producers have really come after these components. Who wins from this? I happen to like Becton Dickinson, a terrific medical device company that we spent some time with when we were out at JP Morgan Healthcare Conference in San Francisco this year. Becton Dickinson's got a significant organic growth, superior operating cash flow, recently raised guidance. The stock was actually down a couple of bucks today. Sure, you can say needles aren't a big business for them, that they make much more highly valued devices. That's true. But more customers will be driven to the company, and I think they'll see less Chinese syringe competition, especially when it comes to any new injectables like the GLP-1 weight loss drugs. Either way, it is a win for a very undervalued stock. How about solar cells? The government raised tariffs on Chinese solar cells from 25 to 50%, and the market reacted totally wrong. That's right. The worst solar stocks, the money-losing home solar plays that depend on those cheap Chinese panels, all rallied because they also have a huge short position. The memesters bought anything with an outsized large short position. The mischief-making memesters, they strike again. But there's a real solar company, a made-in-the-USA solar company, First Solar, that's the clear winner. In this crazy market, the stock actually fell $2.50. At these levels, First Solar sells for about 9 times next year's earnings estimates with tremendous growth rate. And this is before we factor in the impact of the tariffs on some of their major competitors. Now, I think it's an out-and-out winner, part of the world where solar might be the dominant power solution by 2030. Stay with us a year from Nextracker where I get that number. Now, while this next one's more diffuse, our government's doubling the tariff on legacy semiconductors from 25% to 50%. Legacy can be a slippery term. When COVID raged, we knew that our country couldn't produce enough of the older, larger form factor chips, not the state-of-the-art NVIDIA kind of chips, making us hostage to foreign suppliers, and then those supply chains got busted. So this is part of a larger strategy to bring semiconductor manufacturing back home. Now, here's one where the market actually got it right. as Texas Instruments, the biggest legacy chip maker, saw its stock jump $3 to a new 52-week high today. Too late to buy? I think so. Same with Microchip Technology, another legacy chip maker. And Analog Devices, one I really like, that hit a 52-week high. Because legacy is a slippery term. There's some edge cases, though. Might be onsemi. And that's a potential winner. They made it hard to get auto chips during the pandemic. Might be worth betting on now that the stock's gotten so low. The biggest winners, though, will be the American automakers. There's a widespread belief that our car companies are going to be roadkill once China's auto industry gets here. We got that from who? None other than the automakers themselves, especially Ford's executive chairman, Bill Ford. He's been the most adamant about the existential threat of government-subsidized competition from the PRC. On CNN, Bill Ford said about 11 months ago, the Chinese, and I quote, developed very quickly, and they developed them in large scale, and now they're exporting them, end quote. He went on to say, quote, they're not here, but they'll come here. We think at some point we need to be ready, and we are getting ready, end quote. Hey, with 100% tariff on Chinese autos, Ford doesn't need to be all that ready. It can focus on other things that actually make money. Now, Biden didn't outright ban Chinese vehicles, but he basically doubled their price. And if Ford can't beat that, well, they might as just well throw in the towel. If we get a firm commitment from the government, it will stop the import of any Chinese car made in Mexico, or at least slap the same 100% tariff on that. Well, that would go a long way to closing the back door from China to here. Not only does this tariff protect American car companies from cheap Chinese electric vehicles, it also means that the regular vehicles, the regular cars and trucks and hybrids will benefit too. I like this policy, but even if you hate it, it's a clear giveaway to Ford and GM, and you got to cash in on a giveaway when you get it. The chief reason GM and Ford stocks sell at the bottom of the S&P 500 barrel is because of this existential Chinese threat. Whenever China's been allowed to dump merchandise, they've destroyed pricing and destroyed companies. That won't happen here now. Not with these tariffs. I've been a broken record on Ford. I'm particularly aware of that. And we own it for the Charitable Trust. It's got a 4.83% yield, for heaven's sake. If Ford can just curtail the immense losses in electric vehicles, I mean, some people think of like more than 150,000 per car, well, then it's much easier with the new tariffs, and the stock can and will go higher, even though it seems to be, as I told my partner David Faber, epoxied to 12. And I can't help that. Home Depot had not that great a quarter. Why do I believe these ideas can work? Because this market cannot walk and chew gum at the same time. Today it had short busting on its mind. It can't handle another thought, like the winners from the new tariff schedules I just gave you. Hey, maybe by tomorrow people realize that First Solar is the winner and the Little Solars are the losers. Maybe they'll realize that Owens & Minor makes personal protective equipment, or Becton Dickinson will boost its margins in syringes immediately. Bottom line, that's how I like to pick stocks. But you can just decide that if it doesn't have a big short position, it's not worth your time. If that's the case, though, you know what? You better hope that Hello Kitty comes roaring back with a litter box with some fresh step dumped in it. That works. Donna in New Jersey. Donna.
Hello, Jim. It's Donna from New Jersey.
I thought so. What's up?
Hey, Jim, Adobe dropped in February, and it hasn't been over 520 since March.
No.
Although targets are over 600, Adobe looks dead in the water. Now, earnings are due June 13. Jim, what do I do? Sell now or hold?
No. It's really the cheapest I've seen. And a lot of this is down 20% for the year. A lot of this is because of belief that they weren't able to buy this Canva and that they have a too expensive a suite offering and they have to cut the price of the suite offering. Shantanu Narayan is going to figure this one out. Now, I don't know how he's going to figure it out. I don't have an answer for him. But I'm betting I'm not running Adobe. And I know that he's a smart person, and therefore I'm banking with him at the level of 475, give or take like 10 or 15 points. So there I go. I'm saying that to Donna from New Jersey. Now let's go to Errol in Indiana. Errol.
Hey, Jim. Why has the profit to earnings remained so flat compared to other stocks when the stock market has been doing so well?
Well, of which stock?
LNG.
Oh, I think LNG, look, okay, so this is a very complicated business right now. LNG we're trying to figure out whether they'll be able to build more plants. We do know that the president said, we're going to put a pause to 2028. It's wrecked the whole industry. It's as if the president somehow felt that it wouldn't matter, and the president was just dead wrong. Now, look, hate it or like natural gas, it doesn't matter. He destroyed the growth industry, and I think it was short-sighted because why? Because I like the fact that our allies were depending on our natural gas. We should have helped them instead of doing something that I think is going to ultimately help the Russians. All right. This This market cannot walk and chew gum at the same time. Today it had short busting on its mind, not making money. Maybe we'll get back to real business tomorrow. On Mad Money tonight, Stanley Black and Decker got hit after earnings, and with the stock returning to pre-report levels, I sit down with a CEO fresh off the company, ringing the opening bell. Then Nextracker reported earnings after the bell, and I'm running through the numbers with the CEO. And CNBC is out with their Disruptor 50 list today, highlighting some of the, don't you love that? Highlighting some of the innovative private companies that are changing the world. So I'm talking with number 22, Chime, to see how the digital-only financial provider is shaking up the space. I suggest you stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
If, like me, you think business has been slowing and the Fed will ultimately have to cut interest rates, then you need to consider what works when rates come down. Take Stanley Black and Decker. That's the toolmaker that reported what I thought was a solid quarter a week and a half ago. But Wall Street didn't really care for it, and the stock got clobbered. I told you we were buying this one all the way down for the Travel Trust at the time, which has been a great decision in retrospect because the stock's down roughly back to where it was before the quarter. It doesn't hurt that this is a very well-run company. It's done a great deal to cut costs in recent years. Now, this morning, Stanley Black and Decker rang the opening bell here at the New York Stock Exchange to celebrate the 100th birthday of DeWalt, its yellow-branded professional division. And a little later, I got a chance to sit down with Donald Allen. He's the president and CEO of Stanley Black and Decker. Take a look. Don, not many companies can withstand the test of time, but here's DeWalt, 100 years. Tell us how it happened and how important this product is worldwide.
Yeah, we've actually had a great morning here at the Stock Exchange, Jim. We were celebrating the 100-year anniversary of DeWalt, and it goes back to the individual that created it. His name is Raymond DeWalt, and he had really three tenets that he focused on. One was innovative products, safety, and then productivity. And those were the three things that he said I wanted to provide to tradespeople so they could be successful on the job site. And that's what resonates today. But now we have an amazing, powerful brand 100 years later that allows us to continue to bring those three tenets to the marketplace.
Well, I think it's important to point out that at a time where we know that housing's not booming and we know that rates are high, that there are things you can do. You can innovate, create some new products. You can make it so that you're more streamlined and build up gross margins. Take share. These are all what you're doing right now.
That's right. And so we've announced a transformation program a couple of years ago. Right. As you're very well familiar with. First focus was how do we get our gross margin rates back up as we went through that highly inflationary cycle, pricing in the marketplace, streamline the supply chain. And as we exit this year, we'll be around 30% for gross margins as a company and getting our path closer to 32, 33% by the end of next year. The other thing that we're doing is how do we gain share in a challenging market? Because, the market is in pockets, the consumer market's down, pro market's still pretty healthy.
DeWalt.
DeWalt goes to the pro, which is fantastic. Right. And so managing that with our different brands and saying, okay, we can find a way to outperform the market in 2024. And then as the market gets stronger, as whatever happens in the future, whether it's lower interest rates, other types of activities that occur, this company is going to be even better prepared to take advantage of that, not only from a growth perspective, but also a profitability perspective.
One of the reasons why we have such respect for your company in the club is that you pay a substantial dividend while we're waiting for those things to happen.
Right.
And we have to understand that you're a dividend aristocrat. We should not be concerned that the dividend is so high.
You should not. I mean, obviously there's a little bit higher debt leverage on our balance sheet we would like. We'll be working on bringing that down by the end of next year to levels that would support the current credit ratings we have. We think the dividend's an incredibly important story to our shareholders. And it has been for many, many years in our company. And so we want to make sure that we sustain that dividend, hopefully increase it as time goes on here, as our earnings and cash flow continues to grow. But, I think it's something that, people can look at it and say, I'm going to get a 4 to 5% yield on a dividend today that It might be challenging to find that type of return anywhere else.
I think so. Now, you do have optionality. You just sold a division and immediately paid down debt, which I just love. And you do have a fastener division. Aerospace fastener is just a fantastic business. Auto, not that great right now. And I would ask you, do you want to sell that? Or the fact is that generates a gigantic amount of cash flow.
Yeah, I mean, right now it's generating about 35% of the company's cash flow. It's a significant part of our EBITDA as well. It's a great business, to your point. I mean, there's a piece of it that's tied to aerospace and, wide body planes in particular and the construction of them. And then there's the automotive piece, although the market's not great right now. We've positioned that business well for the shift that's happening from gas-powered cars to EV. Right. And so we're in both places. So as that market continues to shift, or in some cases, it might be 10 years or more where we have both of these types of products in the market, and we're able to provide the fasteners to both of them.
It could be explosive. Now, a lot of people see Home Depot report today, and some people thought it was disappointing. Again, they're constrained by the Fed. Home Depot is 15%. Lowe's is 15%. I think a lot of people perceive that really this is your whole business, but you're worldwide. There are areas of the world that are very strong. Yeah. So just to look at you and say, you know what, you really are Home Depot is pretty much a fatuous way to look at Stanley Black and Decker.
I agree. I mean, obviously Home Depot and Lowe's are incredibly important customers for us. And the results that we saw from Home Depot actually were pretty much what I thought would happen because they were relatively consistent with our results for Q1. And so there wasn't anything really surprising in that this morning. But you're right. I mean, we have 70% of the rest of the company that we sell through all kinds of other channels in North America. We have a European business that's about 30%, 35% of the total revenue. It's significant. And then we have emerging markets. And so we're in like 60 to 65 countries around the world. And we're able to use that amazing brand like DeWalt in all these different areas. And then you supplement it with the Stanley brand and the Black and Decker brand in some countries. And then obviously the Craftsman brand is great here in the United States.
Sure. Yeah. Now, I think that we should talk about the transformation because what you're doing is really making it so you're making more money in your sales. And that is so often important because you do have a lot of leverage if we can get that done. Not leverage debt, but the ability to be able to make a lot more per sale if things go right.
Yeah, you're right. And I think, when we started this transformation 2 years ago, we probably felt at the time that the market would recover a little faster than it actually has.
Right.
But the good news is that as we built this journey to how do we get our gross margins to 35+%, and I think as we exit 25, we're going to be very close to that number, if not at that number. That's without really very little growth. And so we're not really benefiting from that leverage impact. And when this market comes back, it's going to print money in a very significant way. And I feel really proud of what the team has done to position ourselves to take advantage of this whenever it happens in 25 or 26. Sure.
Well, I can't resist in the time we have momentarily. I always want to see new products. What's going on DeWalt? But please give us something for Stanley and for Black and Decker because we know that right now you're starting to think about already and have to be ready for the holiday season. What are you looking at?
Yeah, well, I think DeWalt, we launched DeWalt Power Shift at the World of Concrete show in January, which is an amazing set of battery-powered tools that serve the professional that works on concrete construction. And it was a significant launch. We had hundreds of users there trying the tools and eventually buying the tools in the future. That's another wave of innovation in DeWalt. Craftsman, we continue to look at opportunities both in the outdoor space and the garage space. So that's really where Craftsman is strong. And it can be a do-it-yourselfer in the garage, or it can actually be an auto mechanic. And how do we continue to innovate some of the power tools, the mechanics tools in that particular space, and of course storage cabinets as well. Black and Decker, we're working on some interesting things for this holiday season. That's still to be determined.
Well, okay, we'll keep it under wraps, which is important. But I want to thank you so much on a very big 100th anniversary DeWalt Day. That's Don Allen. He's president and CEO of Stanley Black and Decker. And yes, the CNBC Investing Club does have a big position because we think it's a coiled spring, good dividend, paid to wait, and then blast off when rates come down. Thank you.
Thank you, Jim.
Coming up, catching rays? Cramer shines a light on a solar play with a tech twist. Next.
What do we do with these results from Nextracker right after the bell, the solar technology play that helps solar panels move with the sun, maximize their energy output, or to protect them during bad weather. Here's a stock that had been red hot earlier in the year before selling off hard in March and April, along with virtually every other growth stock. But when Nextracker reported after the close today, it delivered another excellent quarter. We're talking a healthy revenue beat with much better than expected earnings and cash flow, a real blowout. I thought the guidance for the company was conservative. Let's take a close look at the quarter and check in with Dan Sugar. He's a.k.a. Shug, they like to call him, the founder and CEO of Nextracker, to get a better real situation. Shug, welcome back to Mad Money.
Jim, thanks so much for your interest in Nextracker and our solar sector.
Of course. Now, you had another strong quarter, and what we want to do is just maybe get some of the key drivers of how this could be so much better than expected.
Well, first of all, Jim, the economics have never been stronger for solar. Solar is the lowest cost way to generate power on most of the planet, and we're seeing demand accelerate both in the U.S. and abroad. And for Nextracker specifically, we have differentiated products that make more energy, are lower cost to operate, and reduce risk for owners. So we're just seeing a lot of very strong demand, which is why we've been able to set our guidance up for next year.
Now, the president today put in some tariffs for solar panels, and I wanted to know whether that's going to make it less economic for your clients to do solar.
The tariffs that were put in place don't impact our utility scale solar and are factored into our plan. So they're really more focused on the EV industry and other industries, Jim.
Okay, good to know, because I don't want to feel like that what's happening is whatever you do good, they take away. Certainly don't want that. Now, I also was looking at the backlog. It's at $4 billion now. What is it? I mean, that's an incredible growth since we saw you last. Tell us where you're getting that business from, because it's obviously not just the United States.
Right. That's correct, Jim. We're serving today almost 40 countries around the world, including the U.S. The U.S. is our strongest market, but we're seeing very strong growth in South America, Australia and Oceania, Africa, the Middle East, and India. And our backlog basically doubled in 2 years. A year ago, it was $2.6 billion. A year before that, it was about $1 billion. So now we're at $4 billion of backlog for the company. So what we're seeing is tremendous growth in the sector, and Nextracker's continued. We've had about a 30% compound annually growth for 5 or 6 years in a row up till now.
Any great use cases so that people understand exactly what you do, situations where we would normally not expect solar to kick in? Because you know what we always hear? Oh, solar's really good, but it can't be baseline. It's never going to be that. It's too intermittent. And it's like the way they like to slag the solar industry. I know when it's dark, a total eclipse of the sun, not your best day. But I have to admit that the idea that this thing is as intermittent as people say is just people trying to knock down solar.
You nailed it. Because battery costs have dropped so much, we're seeing batteries associated with most of the projects that we're involved with. And in fact, if you look at solar and solar plus storage, which really means batteries, if you look just in the United States, there's over 7,000 projects that have applied for interconnection to the grid. And in total, that amount of capacity is about 1,500 gigawatts, which is more than the 1,300 gigawatts of existing capacity in the US grid. So because the batteries allow the power to be there when you really need it, we're just seeing solar and solar plus storage dwarf legacy energy technology. In fact, there's zero new nuclear, zero new coal in the interconnection queue, and solar and storage have 25 times more interconnection positions to get hooked up to the grid than gas does.
Well, don't you think it's interesting that, for example, I took your numbers from your grid, which showed that maybe we could be 25% solar, 25% wind in 2030. Dan, everybody seems to think that you're being too aggressive. Why are you sticking by your guns on that?
Well, it's not just Nextracker, Jim. The U.S. Energy Information Administration, the government's know-how place for what's going to happen with energy, which historically has been very conservative on solar, has forecast a 26% annually compounding growth. And within 10 years, solar will be the #1 source of energy in the U.S. grid. And that's borne out by our 5 to 6 years of 30% growth. So we see it's happening, and it's driven by fundamental economics, where solar is the lowest cost way to generate power on most places on Earth. In fact, the systems that we're seeing going in today are about 1/10 the cost of systems 15 years ago.
Jeez, that's
so
incredible.
It's really about technology and fundamental economics.
Okay, now I know you've got this great graph in one of your decks. Nextracker has proven solutions to mitigate severe weather. Weather events make up 62% of all solar losses. Hail, 54%. Then I read this article about how in a renewable energy world, not my usual publication, that you actually had a hailstorm in Texas that did damage some of your solar panels. Care to discuss that? Because I know that you taught me that hail is a huge problem for solar.
Yeah, we're seeing extreme weather on the rise across the world, and in what we call Hurricane and Hail Alley from Texas up through the Pacific Midwest. We had a customer about 3 or 4 years ago that had a hail event, and we developed a hail stowing technology. In this year, we saw on 27 projects that our hail stow technology was triggered. We talked to the owners of all those plants, and there's no reported damage on them. So you can't mitigate every situation every time, but there are technologies out there to help renewable energy perform in a wide variety of conditions.
Okay, now, how much of your business is because of companies like Microsoft and Alphabet, Google saying, look, guys, unless you use Nextracker or something like that, we're not going to give you the business. We're not going to put our data centers near you. How much are they recommenders for Nextracker?
Well, there's both a desire to have carbon-free and environmentally preferred generation, but there's also a need for power, Jim.
Right.
What we've seen in the United States is that power consumption was fairly flat for about 15 years, but it's really accelerated as the result of reindustrialization, electrification of appliances like vehicles, and data centers. And so these data centers, they need energy, and they want renewable energy because it's lower cost and more environmentally preferred. So we definitely see the growth of data centers as a huge demand generator, both for the grid and also for the renewable power sector.
Well, that's terrific, and it continues why I think that you're able to blow away the numbers. I like the conservative guidance. I don't want you to start raising numbers, get ahead of everybody. That's smart. Anyway, that's Dan Sugar. And Dan Sugar is the founder and CEO of Nextracker, NXT. Congratulations on a great quarter. You really blew the numbers away.
Thanks very much, Jim.
Absolutely. Mad Money's back after the break.
Coming up, dive on into a disruptor. Does this fintech favorite ring a bell? Find out next.
Every year, our network comes out with the CNBC Disruptor 50 list. It's a collection of revolutionary startups that are reinventing entire industries. Even though these companies aren't publicly traded, many of them have eyes on coming public in the future. Many others can tell us a great deal about what the future looks like. Which brings me to Chime Financial. This is number 22 on this year's Disruptor 50 rankings. Here's a financial technology company that partners with regional banks to provide fee-free mobile banking services. Okay, now it's very much aimed at people who've been, I think, left behind by the current banking system. So tonight I want to take a closer look with Chris Britt. He's the co-founder and CEO of Chime. To learn more, Mr. Britt, welcome to Mad Money.
Thanks, Jim.
Okay, so when I was looking at all the background information, what it seemed to me was that you're taking care of the huge number of people in this country who don't have much, and paycheck to paycheck is their watchword.
Yeah, approximately 2/3 of America lives paycheck to paycheck. And so we tried to create a new model for consumer banking that doesn't rely on fees and help this segment of the population with their most acute needs, which is really around short-term credit extension, credit building, and avoiding fees. And it's really working well.
Now, I would say that most of these people, from my own experience, aren't really wanted at the banks because they can't make enough money off these people.
Yeah, look, 80% of Americans make under $100,000 a year. So it's a huge segment of America. About 150 million people live paycheck to paycheck. So it's a massive segment. And I think if you think about how banks go to market, how they make money in checking account business. It's really a NIM-based business model. What's required for NIM? You need consumers with large deposits, and you need people that are creditworthy in a world that the credit box for who they're going to give loans and credit to is becoming smaller and smaller.
Right.
So we've taken a totally different approach, and we partner with these banks to give fee-free checking accounts, and we don't rely on fees. We really monetize the relationships through transactions. So when the Chime member uses their card for everyday purchases, in our case, over 40 transactions a month on average, we're able to monetize that way. And what's great about it, it's very aligned with the consumer. We only monetize the relationship if they keep us top of wallet and think of us every day.
Well, what I also like is that you've got this plan where people can access their money a little earlier than everybody else, because everyone else is these brick and mortar outfits, all they want to do is try to make as much money every little way they can, including the float. That is not what you do.
Yeah, they make a lot of money from fees. We help with short-term liquidity in a variety of ways. We were the first company to offer 2-day early access to your paycheck when you get direct deposit. We also were the first to offer up to $200 of fee-free overdraft. And now we're launching a new product called MyPay. And with MyPay, consumers that sign up for a Chime account, you can sign up right now. We just are launching the wait list for this new product right now. All of your viewers can come on.
No, I'm glad you're not seeing our show. I appreciate that.
So you sign up, you get direct deposit of your paycheck. And then if you think about the way payroll works in America, about 70% of Americans get paid every 2 weeks. And so the question is, if you've worked 2, 3, 4 days in the week, why should you lend your employer the money that you've earned? Right. So now with this Chime MyPay service, anytime into the pay period, you can click access to that paycheck on demand up to $500. There's a totally fee-free option that you get access to in 1 to 2 days, usually in 24 hours. Right. And then we also have an option where you can get it instantly for $2, so less than the price of a out-of-network ATM fee.
Okay, when I go to where my mom grew up, in a tough neighborhood now of Philadelphia, every other block is a check cashing outfit. Now, I can't see why you would ever have to go to a check casher if your bank's there.
Well, we'd love to get rid of the payday lending.
Do you regard that? By the way, do you regard that as antediluvian? It doesn't belong anymore,
well,
right?
We see this as a totally different product, right?
Okay,
we aren't just doing a one-off transaction
right.
with someone. We're in the business of developing primary account relationships. In other words, people that get ongoing direct deposit.
Right.
And when we do that, we're able to take risks on people that otherwise may not deem to be, worth taking a risk on by some traditional institutions. And we don't have to charge high fees because we're able to monetize the relationships through this primary direct deposit relationship that we enjoy with the majority of our members actually use us in that way.
Well, how do you help people save? What do you teach them? What's available to them?
Well, we have a whole host of financial education services. We have games to help them. We do a lot of culturally connected social posts. People don't want to be lectured. They don't want to read textbooks, but we have tools to help people save money automatically. And of course, getting your finances right starts with avoiding fees. So that's sort of foundation.
Okay, so let's go over games, because we know after what's happened with the GameStops and the AMCs, we don't mean that kind of game.
Like educational.
Right, I want to be clear, because
your knowledge.
Someone might say, oh yeah, it's just a gamify and that kind of thing. So when I open an account, I do want to have my direct deposit goes to you. Right.
It actually goes to one of our 2 partner banks.
Right. Okay.
So we offer FDIC insured, Reg protected checking accounts. This isn't going to some phantom pool that is unregulated. Everything is regulated by the OCC through our bank partners. The money stays in those accounts. It's essentially, think of it as like a tri-party arrangement. Consumer signs up for an account with Chime and one of our partner banks. All the money stays in there, and they get these short-term liquidity and credit building benefits that we offer.
Okay, I've got to ask about it. Crypto, it just doesn't seem to be part of the operation. Should it be?
We're not focused on crypto.
But what happens if
I think there are applications for crypto. I think around storage of value, particularly
what I think
in certain markets. Probably international money movement and so forth. For our members, some of them certainly do trade in crypto. A lot of our members are still they're still early in the process of developing their investment plan. So we don't want to start with crypto as kind of the lead in that area.
No, in that sense, I get it. Because I'm always very concerned that there are people who start out at another firm that's for young people, and they fizzle. And now it's gone right for now, but it's destroyed a lot of people. Yeah. So I think you're actually being prudent. I don't think you're being condescending. I think you're being prudent.
Yeah, I have respect for a lot of those companies too. But when we do launch investing services, which we don't have yet, we will likely start in a regular rhythm of investing into a low-cost ETF or setting up an IRA, those sort of things. We don't have ambitions of creating a trading app.
All right, very good. Please don't. Anyway, so Chris, I've got to ask you, I know that it's a sensitive issue, but any plans within the next, say, year to be public?
Oh, we're excited about the prospects to be a public company.
Good.
We don't have plans in the immediate future, so it's not a 24 thing, but it is not too far out in the distant future.
Well, good. We
can definitely see that on the horizon.
I like to encourage outfits that help the regular people because that's what we all started as.
That's what you do.
Regular people. Anyway, don't still be regular. That's Chris Bridges, co-founder and CEO of Chime, number 22 on the CNBC Disruptor 50 list. And as you can tell, I'm very excited about it. You can get the full list of CNBC Disruptors at cnbc.com/disruptors. Please don't miss Disruptor Gecko Robotics tonight on Last Call. Mad Money's back after the break.
When we return, master the markets one stock at a time. The lightning round is up next.
It is time! So the lightning round commences. Put on 77 stock trade. Buy, sell, up. Stanley Black playing this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. I'm going to start with Norman in New Jersey. Norman.
Hello, Jim. Booyah.
Norman, what's going on?
I'm calling about a stock. Some of my family members owned it back in the day when it was running up to 400, and now it's down about 130. I've never owned it, but I'm thinking about it. What do we think about Moderna?
I'm a believer. I've been a believer with Stefan Ben Selson since 16. I've never backed away other than the fact that it went crazy during COVID. And then it crashed, and ever since it crashed, I'm in. Let's go to Barry in Florida. Barry.
Yes, long-time listener, first-time calling.
Oh, excellent.
Jim,
Good to have you on the show.
It's great, and I'm also from Philadelphia, right
there you go.
From your alma mater. Okay, MindMed.
I like MindMed. I am a big believer in, by the way, I'm in Vertex too. I'm into it. Anything that makes it so that there's ways to be able to get rid of pain and do good without getting people hooked, I am all in on. Doesn't necessarily mean it'll make a lot of money. I don't care. I think that people have to recognize this is an unmet need, and it will make money in the end. Let's go to Dennis in New Jersey. Dennis.
Booyah, Mr. Cramer.
Booyah, Dennis.
Dennis. I'm a first-time caller.
Okay.
And I'm calling about Modine Manufacturing.
Okay, that kind of metal-bending industrial company is precisely what's working here. And it's what we preach at the club. And that is a club-like name. All I can do is a club, not mean like a club like that. I mean like more like the group of people, not a club. But I like the concept. How about Perot's? Oh, we've talked to Perot's before. Perot's in California. Perot's.
Hey, Jim. How's it going?
Not bad. How about you?
What's that? Good. I just need your help on this stock I'm looking at.
Sure.
They are in the electromechanical space. They make devices, and they also produce gas analyzers for the semiconductor industry. The chart looks fantastic, lower left, upper right, as we like it. And, so just wanted to get your thoughts on AME, Amatech.
Oh, man, come on. Amtex is one of the great industrials, too. I mean, absolutely terrific company. I used to own a ton of it when I was at my hedge fund. I like what you're up to. You need to go to Jerry in Missouri. Jerry.
Hey, Jim. Thanks for taking my call.
Absolutely, Jerry. What's going on?
Well, the meme stocks have seemed to have a pretty big two-day run, and my stock has been trading with them. This company has made a terrible decision, in my opinion, to use electric vehicles, and I consider the way they charge customers for recharging them upon return almost criminal. But I don't think that's the future because they say they're selling their EV fleet. Jim, should I sell or double down on my Hertz position?
I don't want you to sell, and I don't want you to double down. Let's just see if it can't go higher. I don't like the fact that my friend Steve Sure left it. I do think that it's probably too cheap right now, but if it got to 8-9, I would sell the stock. Let's go to CJ in Florida. CJ.
Hey, Jim. Booyah to you, Jim.
Booyah.
Thank you very much for all you do for everybody and hands-on hard work that you do.
Oh, thank you. Thank you very much.
Make a few dollars here and there. But,
thank you.
I am looking at a stock. I have a substantial position in PLT or Palantir.
Palantir. Okay. Okay, here's the problem with Palantir. The quarters are uneven, and Alex Karp doesn't want to come on the show, and I don't really understand how I can possibly make a judgment unless he comes on. So there we go. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
When I see meme stock mania taking over again, led by GameStop and AMC, I need to remind you that this is irrational. There's no way these stocks should reach such elevated levels on their own. At one point today, GameStop had a market capitalization of nearly $20 billion, although it finished lower, just under $15 billion. But people were buying or selling millions of shares at those exalted levels. Was GameStop worth almost $20 billion? At the end of the day, it's worth what buyers will pay for it. I accept that. However, I prefer to be a little more rigorous than that because I want something with staying power. The best way to figure out what a company might be worth is to compare it to another company in the same industry. For GameStop, I think the closest compare is Best Buy, another electronics chain with lots of gaming exposure, and one that has a $16 billion market capitalization at the moment, not that much higher than GameStop did for today's ridiculous run. How do they stack up? Let's use the last 4 years. In the last few, that period's a very good game. GameStop revenues have bounced between $5 and $6 billion. Best Buy, meanwhile, did $43.5 billion in sales this year, almost an order of magnitude higher. How about earnings? After losing mountains of money from 2020 through 2022, GameStop made about $17 million last year. That's an M. By contrast, even though Best Buy's earnings have been on the decline, it still made $1.4 billion last year. Billion with big. You could argue that GameStop's on the upswing while Best Buy's seen its profit go lower. But if they have roughly the same market capitalization, an electronics retailer that's making $1.4 billion should be worth a lot more than a gaming retailer that's making $17 million, don't you think? Hey, don't forget that Best Buy pays a generous dividend with a 5% yield at these levels, while GameStop pays no dividend. Altogether, I don't see how these two companies that do roughly the same thing can be worth roughly the same price. According to Wall Street, Best Buy's numbers are so much higher. I'd love to tell you it's radically undervalued because we own this one for the Charitable Trust, but at best I can just say Best Buy is too cheap. Well, how about the possibility that GameStop can't be judged by its current state? Instead, we need to think about how the company can reinvent itself by selling stock here. Well, let's say they can sell $1 billion worth of stock, something I think the SEC would actually probably let happen because they don't seem to care either way. If GameStop had an extra $1 billion, it could get out of some bad leases, maybe make a little more money. Maybe you can use the stock to make an acquisition. Have them go buy Best Buy, for heaven's sake. GameStop's market capitalization was well above it at one time, but I don't think any potential takeover candidate would be willing to accept a stock deal if GameStop's at these levels. Even if they did, it would crush the stock, and the short sellers who currently are being crushed would make out like bandits. Those who own it would have egg all over their faces, as the stock would be obliterated if GameStop did a gigantic offering to pay for a transformational acquisition, because that's what it needs, as the current business is dying. So the most obvious comparison says GameStop's overvalued. The company's been reluctant to change its stripes, and it can't use its stock to buy someone else without ruining the shortbuster thesis that got it here. I just can't get 64, or I can't even get the 44 for that matter. In short, when I see this running GameStop, the responsible move is simply to say, sell, sell, sell. What about AMC? Different situation entirely. GameStop at least has a good balance sheet and actually turned a profit last year. It's just that the stock's overvalued compared to its peers. But AMC, well, if left to its own devices, I think this movie theater chain will mostly run out of money in 2026, when $2.8 billion in debt comes due. They sold some stock yesterday from a plan that allows them to raise capital, but the $250 million they raised just made it easier for them to pay their debts that come due in 2025. If the stock keeps climbing, AMC can sell more stock. That's good. It's how these guys made it through the pandemic to begin with. But that big slug of 2026, it's just way too daunting. In the end, I think it's a dead man walking. You're catching AMC in the walking phase. Sell it before the dead man phase, and you'll do just fine. I like to say there's always a bull market somewhere. I promise I'll find just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.